Welcome back to Lamb's Cryptoverse. Well, usually I give a big introduction, but today I'm just going to cut to the chase. I'm going to tell you why MPT, Modern Portfolio Theory, does not work in crypto. So on this first page, you could see I have a little spot here for your coin. Where is your coin here in the efficient market frontier? Think about that. So what is Modern Portfolio Theory, or people call it MPT? This was developed by Markowitz way back in 1952. It refers to investment theory that allowed investors to assemble an asset portfolio that maximizes expected return for a given level of risk. So that's really important. Basically, it shows you where you can maximize that return, but the key point is for a specific level of risk. And in order for this to occur, it uses this idea called diversification. Everyone knows about diversification now, but years ago, people did not know about that. And they didn't even know about holding portfolios. It was mostly about, buying one or two stocks. And for those that don't know, diversification is a way of lowering what's called idiosyncratic risk. That's a fancy way of saying company risk or individual risk. What else did I miss here? Portfolios can be diversified in multiple ways. Yeah, this is a pretty important point. It's not just diversifying by buying Tesla and Ford and GM, because are you really diversifying if you're buying 3 car companies? What you need to diversify is with different asset classes, different markets, different countries. That's what they're talking about. So what is the efficient frontier? This is from Eugene Fama, way back in 1965. He's from the University of Chicago, still there. And the definition is that I could show it later, but I'll just read you the definition. It's a set of investment portfolios, and that's a key word, portfolios, that are expected to provide the highest rate of return for a given level of risk. So it's said to be efficient if there's no other portfolio that gives a higher return. So basically, you're getting the best portfolio out there. The efficient frontier, and I'm going to show you this chart later, is basically a curved line that shows you where that portfolio is on that curve. So here's a practical example. I was going to give you some examples on Excel, but instead of doing that, I'm going to have you learn it from an intuitive point of view. So let's look at 2 portfolios. This portfolio 1, that has a return of 12%, and portfolio 2, that has a return of 10%. So 12% versus 10%. Now the risk, which is also called sigma, or SD for standard deviation, or volatility, is 20% for portfolio 1. But for portfolio 2, it's 5%. And then we can figure out what the portfolio's expected return is by getting the weightings for each portfolio. So let's think of it intuitively, a real simple way. If you put all your money in the portfolio 1, your return risks are going to be the return for portfolio 1 and the risk for portfolio 1. So your return is going to be 12%, your risk is going to be 20%. But if you put half of your monies in portfolio 1 and half in portfolio 2, your return is going to be a middle, right? It's going to be between portfolio 1 and portfolio 2. It's going to be the middle or the average return. So let's just do it intuitively. If you take 50% of portfolio 1 and 50% of portfolio 2, it's going to be in the middle. So it won't be 12% or 10%. It's going to be in the middle. So the return is going to be 11%. And the same thing with risk. If you got 50% of your portfolio in 1 and 50% in 2, obviously your return, your volatility is not going to be 20%, and it's not going to be 5. It's going to be somewhere in the middle. 20. Basically, it's going to be 20 plus 5 divided by 2, whatever that is. Probably like something like 15%. So that's the key point. It's going to be a weighted average of both return and risk. But then we look at Sharpe ratio, and this is the key point. So the key point is not calculating these returns. It's what is your return per unit of risk. And for that, we look at the Sharpe ratio. And basically what you're doing for the Sharpe ratio, you're taking the excess return over the risk-free rate. And we don't even need to worry about that. Just think of return over risk. So for portfolio 1, you're getting a 12% return, but you're taking a risk of 20%. That's a high risk. And for portfolio 2, you're getting a 10% return. So the return's only 2% lower. Not only that, but your risk is 15% lower than the first portfolio. So your risk is 5% rather than 20%. So you're getting a pretty high return with a much lower risk, I should say. This is not realistic, by the way. It doesn't work this way. It's not that easy to figure out. But in this case, for representation purposes, I'm showing you that you're getting much more return per unit of risk. If you look at that Sharpe ratio, what you would do is you would take that 10, forget about the risk-free rate, let's just say it's 10. 10 divided by 5. So you're getting a much higher rate. 10 divided by 5 is going to be 2. That's much better than 12 divided by 20. It's a much better return per unit of risk. Of course, the formula is more complicated than that, but I just want you to understand it intuitively. So let's go to the next. Let's not kill this. Let's go to the next slide. Again, this is just repeating what I said earlier. In layman's term, investors are going to prefer higher returns with less risk. So it's that simple. And how do you get that? And that's my second point there. It's by investing in diversified portfolios. And here it is. This is what I promised I'd show you. This is the efficient frontier. And so you prefer, and I put a bubble there for you, you prefer that upper bubble, which says prefer this portfolio, not the lower bubble, the lower dot, which says not this. And you could see why. For the same portfolio standard deviation or risk, you get a much higher return of 10% versus, what did it say here? I think it's 7%. So you want to invest in those portfolios that have higher returns per unit of risk. In this case, I made those two portfolios have the same risk, so it's easier to understand what I'm saying, the point of this. And remember, and we're going to talk about this later, but we're talking about portfolios here, and I think under assumptions I talk about it. Here it is. So problems with assumptions of MPT. We're going to talk about this in another presentation. But there's a lot of problems using MPT, and it's not just for crypto, it's even for equities. And I'll just go over one or two of them, and then we could talk about them in another presentation. Let's see, the first problem is, these assumptions. This is the first point. I said basically, the assumptions were chosen because they're historically available and they're easy to insert mathematically. So what does that mean? It means that they're available and you can find them using computer databases, right? And that's the thing. It's easy, but doesn't mean that just because it's easy doesn't mean it works. And my second point that I mentioned earlier is that it assumes that investors are adding portfolios, not individual assets. So we're not talking about adding Tesla with Ford or diversifying Tesla with Ford with maybe a gold mining company. We're talking about portfolios here. And you can read the rest of these on your own, but we're going to have another presentation that talks about this in relation to crypto. I like this quote from Howard Marks, who manages the corporate, I think it's a high yield bond fund, and he's done really well. And he said, It's my view that whether you know it or not, academics settled on volatility as a proxy of risk, as a matter of convenience. Like I said earlier, it's because it's out there, it's available. But the problem is investors don't care about volatility. They're worried about losing money. If something's volatile but it goes up like crazy, investors are okay with that. Let's see, and my second point here is Ben Graham. He said the best way to handle risk is to avoid it. So this contrasts with the traditional finance theory that we're talking about of risk and return, where you take risk, but you want a higher return for that risk. Ben Graham said the opposite of that. He said, don't even take risk. So there's a lot of contradictions to using modern portfolio theory. And I like this quote the best. Eugene Fama, who's basically Mr. Efficient Market Theory, he said, and I'm going to read this quote to you, he said that beta as the only variable in explaining returns in stocks is dead. What we're saying is that over the last 50 years, knowing the volatility of an equity doesn't tell you much about the stock's return. Eugene saying that is like the Pope announcing that there is no God. I mean, think about what he said. So the key takeaway, modern portfolio theory does not work for anything. It doesn't work for equities. So if it doesn't work for equities, why in the hell would it work for digital assets or crypto? The reason why I think people use modern portfolio theory in these engines, these black boxes, because it gives them a false sense of comfort. Because the individual investors, don't understand crypto. And by using black boxes, they feel more comfortable investing in crypto. So please stay tuned and click on our next video, which talks about modern portfolio theory for cryptos and what a solution that we can use to get as a workaround modern portfolio theory. Well, thank you all for listening, and please subscribe to us and like us.